Hello, this video is about why your budgeting sucks. I just want to give a quick disclaimer. I'm not a financial advisor. I'm not even a finance major. I'm an accounting major who likes investing in stuff. So don't take anything I say too seriously. First of all, what even is budgeting? I think a good way of showcasing how budgeting works is by showing two different people. One named Jim and the other named Johnny. Jim doesn't have a college degree while Johnny does. So obviously Johnny's a lot smarter. They both have a monthly income of $10,000, yet Jim is living paycheck to paycheck while Jimmy is just thriving. If they're both lonely and have no girlfriend, no baby expenses, then there must be some underlying problem going on which will show why Jim is suffering and why Johnny's not. And the thing that'll show that problem is called a budget. A budget is literally just a plan for your money. It tells you where each dollar is meant to go. Let's take a look at both of their budgets, which sort of just show how they wound up spending each of those dollars. Here we can see that. Oh, wait. Give me a second. Alright, that's better. There you go. Here we can see some problems with Jim's spending. This guy lives in a house he can't afford. To be fair though, I don't think any house is affordable these days. Has quite a lot of interest payments on debt, spends a lot of entertainment, has no savings and nothing related to his future retirement. Johnny, on the other hand, has a lot more balanced budget, with money going into his future. He has more reasonable spending on entertainment and is overall doing just fine. So how can somebody go about building a proper budget? The first thing you gotta do is determine your after-tax income for the month. This is because we have to pay taxes and you can't use that tax money to fund other stuff. Okay, unless you want to commit tax evasion. No, you can do whatever you want. I don't really care, to be honest. All you do is take your gross income, which is your income before taxes, reduce it by the taxes that you pay. Chances are your checks already come after tax because your employer would deduct taxes from them. And then this would yield your after-tax income. You should also be tracking your expenses so that you know how much you're spending on XYZ. It's a good practice to break down your expenses into fixed, variable, and discretionary expenses so that you know the nature of those expenses. Fixed expenses are those that you pay regardless of the amount you're going to use the underlying thing or regardless of your habits, like rent. You're going to have to pay a set amount for rent. The amount doesn't increase depending on activity or anything. Variable expenses are amounts that you pay based on how much you use or your habits. Like if you're really fat, then your grocery bill is going to be higher. Or if you drive your car a lot, your gas expenses are going to be higher. And then you have discretionary expenses, are just wants that you have, like Pokemon cards. I mean, if you want to consider them a need, then you can do that as well. I don't really care. It's a good practice to break it down into these things because depending on the expense's nature, you might not be able to change very much in the short term. Like your rent payment, you can't really do that much to reduce it in the short term. Whereas your grocery bill, you can just stop eating as much as you do. And before making your actual budget, it's also important to know your financial goals. So many people these days are focused on the short term, and they end up wasting all their money on useless garbage. Like I worked at a job as a tax accountant where I filed people's taxes and so many people were making so much money. Like some of them had literally zero investment income. All of their money was going to these expensive houses. Their mortgage expenses were so high. But to be fair, the short term is still important. Everybody should be paying off their credit cards and they should have an emergency fund of about like 6 months of expenses. For the medium term, people might want to save some money to eventually pay for a wedding, a car, and for the long term, people gotta look at investing a certain amount of money each year or month that'll be used for their retirement. The earlier, the better. Now we have the actual methods for budgeting. The first method is the 50-30-20 rule. This is where you take your after-tax income or before tax if you want to go through tax evasion or whatever, I don't really care, and allocate 50% of it to needs like rent, food, utilities, transportation, insurance, or if you have a gambling addiction, maybe that can go there too. I don't really know. 30% to wants like eating out or entertainment, and 20% for savings and debt repayment. The pros of this method is that it's very straightforward, it's very simple. You literally just have to ensure that the breakdown of what you spend aligns with those percentages. And the cons of this is it might be too simple. In some countries, the standard of living is just so high. I mean, we can literally just do a Google search and oh my god, okay. Yeah, so maybe 50% is not possible for some people. Also, some people have inconsistent earnings and don't make the same amount each month. So it'll be difficult to know whether 50% of whatever income you make is sufficient to pay off your needs. Overall, this is a fantastic strategy for beginners because of its simplicity. And you might want to make some tweaks here and there for those percentages so that's based on your life situation. The next method we have is a zero-based budgeting method, where you take your after-tax income and you assign each and every dollar to a certain expense or a task so that by the end of it, the amount of dollars that you have left is zero. This is pretty much what we did for both Jim and Johnny. You have their initial income and everything they're going to use that money on. And I would say the main pro to this is that it forces you to be very intentional with each dollar that you spend. This would help you from spending money on certain garbage, like in Jim's case. If he actually had one of these, he probably would have realized that he should spend less money on food. Yeah, because I mean, other than everything else seems very important. Yeah, less money on food and more on investing. And the cons of this is that it would take a long time to associate each and every dollar with something, and it might feel very restrictive. I mean, what happens if an emergency pops up? How would this affect the budget? You'd have to shift everything around. Also, if you have inconsistent earnings, then it would be nearly impossible to associate each dollar with something because you don't even know how much money you're going to have in the first place. This is probably the best for people that want to break down every single thing. Okay? It's still a great method, of course. Any budgeting method, fine, just pick one, right? Another method is the envelope based method. This is where you allocate money into envelopes for each spending category, like groceries, gas, eating out. Once an envelope is empty, you can't spend any more in that category. It can be physical cash or it can be using some like digital envelope app. The main pro of this is that if you use physical cash, it helps reduce impulse spending to like a high degree because your spending limits are so clear. There's literally just an envelope there with money in it. Once the envelope is exhausted of money, then you can't spend any more on that category. The con of this is that if you use physical cash, you lose on the potential interest that would have accrued if you left some of that money in a savings account or an investment account, especially if the sole purpose of that money was supposed to be set aside for saving. This is the best for people who tend to overspend and need visual limits to keep themselves accountable. Keep in mind though, you would have to combine this with like either the zero base or the 50-30-20 rule in order to determine how much money should go in what category. Finally, the last method is the pay yourself method. Using this method, you treat saving/investing like a bill. On payday, you move money directly into savings or your retirement accounts or debt repayment. Then you can spend the rest of it however you want to. The best way would be to spend the remaining money in accordance with either of the first two budgeting methods. The pros of this is that it forces you to save money. You can also automate this using some like banking institution that you have, like maybe Wealthsimple. It allows you to take money, like a specific amount of money each month, and put it into like in my country use a TFSA, and in America it would be something else like a 401k or whatever. The cons of this is that you might end up having to spend more money than the amount that you had allocated for spending however you want to. And this wouldn't be much surprising because I mean, you know that paycheck to paycheck situation that we've been looking at. This is the best for people who want to prioritize savings, but they don't want to track every single purchase. And my final suggestions is just determine what your financial goals are in the short term, medium term, and long term, and just pick whichever budgeting method you think best fits it. Don't overthink it. Finance shouldn't be that hard. Just pick some method and just go for it. It's not that deep.